Okay, folks. I always get dragged about it's on. It's too much noise. I always get dragged about wearing a non-NYU sweatshirt. But you know what? I hate NYU's colors. I just no. And second, there isn't an NYU sports team that I've pulled for in my entire lifetime. I don't even know whether they have a sports team. So I'll stick with my UCLA shirt. I have a Cal shirt. I might even wear a Notre Dame shirt, even though I have nothing to do with it. And Stanford, I love the color. I mean, I'll wear. So I'll wear whatever has a better color, and NYU is not it. So don't view this as some kind of unpatriotic. Is it the right word even for But it's not that I don't care about NYU. Maybe I don't care about NYU, but no, don't read that as the message you get from this. So before we start on today's session, I'll give you a preview of what we're going to do. We're going to wrap up the risk-free rate section. We're going to talk about, hey, what do you do when rates are really low? Start of last year, T-bond rates were at historic lows. What do you do when rates are negative? No. And we'll talk about what you should do and what you should avoid doing. And then we're going to talk today about risk premiums in the US, and basically we're going to start with equity risk premiums. What's the price of risk in the equity market? How much do investors charge for investing in equities? And I'm going to give you different ways of estimating it and the pluses and minuses. But along the way, we'll also have to deal with the fact that I think is kind of a reality, but people still push back against it. The equity risk premium you should demand for investing in some parts of the world are higher than the equity risk premium you should demand for investing in other parts. Everybody agree with that? That if I am a business in the Democratic Republic of the Congo, the kind of equity risk premium I will charge will be different than the equity risk premium I charge in South Africa, which will be different than the equity risk premium I charge for a Swiss project. So I want to talk about how to estimate equity risk premiums in different countries. And along the way, I'm going to pose a question to you, because a lot of valuations seem to assume that risk comes from where you're incorporated and traded. That if you're an Indian company exposed to Indian country risk, Indonesian company, Indonesian country risk, Brazilian company, Brazilian country risk, and that strikes me as insane. Why? Because if you're Infosys and you get 90% of your revenues outside India, why should I treat you like Tata Motors, which might get 70% of its revenues in India, Tata Steel that might get 91% of its revenues in India? Risk comes from where you do business rather than where you're incorporated and trade. So I'm going to, the start of the class test is going to be focused on that risk and how do we measure that operating risk exposure. So let's set up the example. You have an Israeli company headquartered in Tel Aviv that gets 95% of its revenues in the US. There are a lot of Israeli software companies that get the bulk of their revenues in the US. Remember, Waze which you might use on that Google acquired, was an Israeli startup. So you have an Israeli company, it's a software company, 95% of its revenue. So the question is, when you value this company, should you be using the Israeli equity risk premium on the rationale of, hey, they're in Israel, they're incorporated in Israel, or should I use the US equity risk premium? Don't be too quick to give the answer. Think about it. Okay? Because it's going to make a big difference, right? Maybe not so much, but if I have, for instance, a company in India that gets the bulk of its revenues in Europe and North America, should I be using risk premiums that reflect where it operates or where it's incorporated? And then I'm going to kind of, as I said, I'm not even going to ask you to pick, because somewhere in the course of the day, we're going to deal with this, because you can see that the logic of using operational risk premiums makes sense, but at the same time, they're still in Israel. Regulations, taxes, that are still, they're still exposed to those. And all the software engineers live in Tel Aviv. You see that when you talk about operating risk exposure, you can talk about revenues. That's one way to measure it. But you can also talk about, where do you produce things? Where are your operations? How do you weigh the two when you decide, where is my risk exposure? Let's suppose you have a Nigerian oil company. And with a software company, you can say, most of my exposure comes from where I sell my stuff. Therefore, I'm going to measure risk exposure based on revenues. And you could probably get away with it, right? Because even though your engineers are in Tel Aviv, if you really, if you felt that Israel was too dangerous a place to run your business, you could put them all on a couple of planes, send them to a different location. Your production is movable, your revenue. But let's change the facts. Let's suppose you're a Nigerian oil company. You're headquartered in Lagos. All of your reserves are in Nigeria. All your oil is sold into a global oil market. So in some revenue level, you can say, look, my exposure is, I'm just another oil company. Is the way we think about operating risk going to be different when you have a natural resource company as opposed to a consumer product company? I think you already can reason your way to an answer, right? Because with an oil company, if you're a Nigerian oil company and Nigeria goes to hell in a handbasket, what are you going to do? You can't pull up your reserves and take them to Switzerland. Say, look, I'll put the reserves in Switzerland. For whatever reason, maybe for a good or bad reasons, God's decided to put oil in the riskiest parts of the world and say, go get it. Right? In this case, you could argue that the way we measure operating risk exposure, not based on where you sell your product, but based on where you extract the oil. Aramco, even though it's a global oil company, is so closely tied to Saudi Arabian country risk that you don't know where the company stops and where the country begins. It's going to be one of the valuations of the week I'll throw up, is their original IPO valuation that I did, because it's going to force you to wrestle with things like, how do I think about political risk in a country? Something that came up with the Adani Group is in Aramco, it's central to the question, right? Would you think about the Saudi royal family and its longevity is going to affect how much value you attach to Aramco? And finally, just to kind of give you a sense, so let's suppose you have an Indian automobile company. So now software company, easy to move things. Natural resource company, impossible to move things. But let's think something that's in the middle. An automobile company, its factories are in India. It sells most of its stuff outside India. Kind of mixed exposure, right? Part of it is, where do you sell your stuff? The other part is, your operations are not easily mobile. They're not as stuck as they are with natural. You could argue that I should look at both my revenues and where my production is. So practically, these are things you're going to face. So when you pick a company, I want you to think about, where does the risk in this company come from? It's come from where I sell my stuff, where I make my stuff, because that's going to have consequences for how you think about equity risk premiums for your company. So let's put this away, because I want to go wrap up the risk-free rate discussion before we move on to how to measure equity risk premiums. So if you remember in the last class, we went through the mechanics of estimating risk-free rate. Some currencies was easy, right? Just take the government bond rate, use it, T-bond rate, Swiss government bond rate. What did they share in common? They were viewed as default free, so you could use the government bond rate as risk-free. Then we talked about the Indian rupee risk-free rate, and we said you can't use the government bond rate. You got to clean up for the fact that there's default risk in there, and you took the difference. So if you get a chance, watch the Valuation Tools webcast from last week, because I take you through the process of cleaning up those rates, where you get those rates. Let's say you've done that, though. You've taken every currency in which there's a government bond, and I'll tell you up front, not all currencies are government bonds. Only about 45 currencies have a government bond. You've cleaned up the government bond for default risk, and you come up with risk-free rates. See this blue portion of the column? At the start of 2023, these were the risk-free rates in different currencies. So I'm going to start with a statement that the chart actually should make clear, but I'll state it anyway. Risk-free rates are different in different currencies. There are some currencies where risk-free rates are high, like the Zambian kwacha. There's some currencies where risk-free rates are low, and some currencies with the risk-free rates can actually be negative. So you ready for the question? If you can answer this question, you've cracked the currency code. Some of you already gave me this answer last session, but let's bring it to the surface. Why do risk-free rates vary across currencies? Notice I didn't ask you, why do government bonds vary across currencies? Because you can do dances about it's a risky government. No, let's say you cleaned up for risk. It's a true risk-free rate. Why do risk-free rates vary across currencies? Anybody want to give that a try? You want to try? Why do risk-free rates vary across currencies? You look like you had the answer, so I'm going to pick on you. Now, maybe you were just brushing your mustache. No. Different countries, there are more risk of default. No, wait. I've cleaned up for that, right? Because these are risk-free rates. Government bond rates, that could be the explanation, right? But let's say I've cleaned up for the default risk. I've come up with risk-free rates. You want to give that a try? No, but let's say growth out of the equation, because countries feed into global growth. But what's the other thing you mentioned? Inflation. So let's be very clear. Once you've cleaned up for default risk, the big reason for differences in risk-free rates across currencies is inflation. High inflation currencies have high risk-free rates. Low inflation currencies have low risk-free rates, and deflationary currencies could have negative risk-free rates. So people are wondering, how the heck can rates turn risk-free? You're going to have a very strange set of circumstances. You've got to have deflation and low real growth, and risk-free rates can turn negative. Now, I'm going to say something that's going to sound absurd, but I'll back it up more substantially later in the class, but you can probably start to see the intuition right now. If you do a good valuation, it should be currency invariant. You know what I mean by that? You take a Nigerian company valued in Naira, you should get exactly the same value as if you took that same company and valued entirely in US dollars. The reason is actually very simple. If you pick a high inflation currency to do your valuation, tell me what's going to happen to your discount rates? They're all going to be high, right? So if you value a company in Zambia and kwacha, don't be surprised to see 25, 27, 28% discount rates. Same thing with Turkish lira. You very quickly start to hit 25% discount rates. And it'll freak you out, especially if you're from a low interest rate environment. But then when you do your cash flows, remember they have to be in the same currency. The wind is now in your back, right? So when you estimate growth in a high inflation currency, even if you're a low growth company, in nominal terms, you're going to see 12, 15, 18% growth. So you're going to have high discount rates and high growth rate in your cash flows. You're going to come up with a value that reflects it. Now you take the same company and you value it in a low inflation currency. First, your discount rate is going to drop. Why? Because you've chosen a low inflation currency. But before you celebrate too much, when you estimate your cash flows, your growth rate now has to be in US dollars or euros, right? So that 15% growth rate you used has to become 4, 5, 6% growth rate. What one hand gives you, the other hand will take away. You can already see why people get into trouble with currencies, right? I still remember a student of this class from like 20 years ago, 25 years ago. He's now the CFO of a very large US company. I won't name the company or the student because it might embarrass him. So he calls me a few years ago. And he's, he clearly wants to crow about how much he remembers the class. He said, I am the CFO of a company. We just did an acquisition of an Indian company. And I remembered your class. And I said, what exactly did you remember? He said, we talked about currency. So basically, we decided to value the Indian company in US dollars. We can do that, right? I said, yeah, you can value any company in any currency. Currency is just a measurement mechanism. He said, when we built up discount rates, we start with the T-bond rate. He was very happy about the fact that he started with the right risk-free rate. He said, I'm bringing country risk. I've come up with a dollar cost of capital. I said, congratulations. And he said, we estimate the cash flows in dollars. I said, how did you do that? He said, we took last year's rupee numbers and converted them into dollars. That's easy enough. Then he said, we estimated a growth rate. I said, where do you get the growth rate? He said, we asked our Indian managers how quickly the company would grow. Let me ask you a question. If you ask an Indian analyst or an Indian manager about growth rates, what currency do they frame the growth rate in? Rupees, right? It's not that they're being deceptive. You think in the currency that you live in every day. So I asked him, did you ask in what currency? He said, should I? I said, you probably should, because you probably paid 3 times what you should have for the company. Do you see why? If I take my cash flows in rupees, and at that time, the rupee inflation rate was 8 or 9%, I put in that growth rate, and then I discount those cash flows with a discount rate that reflects a 1% inflation rate, I'm going to explode the value of the company for all the wrong reasons. Mismatching currencies can cause your valuations to implode. Pick a currency, any currency, but then stay consistent. So when you think about risk-free rates, think about inflation, because that is, in fact, the driving force. Now, yes, go ahead. Okay, let's go there, right? That's the other thing I could do. I could take the rupee cash flows and convert them into dollar cash flows using an expected exchange rate, right? How do I get expected exchange rates? Remember purchasing power parity? Because remember, these are not markets. You're going to get forward rates for the next 20 years. What's purchasing power parity of one currency with a 9% inflation rate? The other currency has a 1% inflation rate. Over time, what's going to happen to the higher inflation currency? Come on, you remember purchasing power parity. It's going to depreciate by roughly 8% a year. So if you decide to do your cash flows in dollars, inflation is the culprit either way, right? Whether it's you're doing it at the discount rate or in expected exchange rates. But you have to use expected exchange rates. You can't use today's exchange rate every year for the next 10 and expect to get any kind of sensible valuation. Now, of course, when you do valuation, this is one of the few comfortable spaces, right? When you do a risk-free rate, this number doesn't change very much. And that's true if you're in the US or Europe. If you're in Turkey, forget about it. Your risk-free rate could shift on a daily basis. But one of the things we're taught is risk-free rates don't change very much in mature markets. Most of the time, that is true. But I'll take you back to 2020, a year we will all never forget, right? Where COVID took away the last year of your high school or the first year of college, whichever it was. First quarter 2020. Take a look at what happened to treasury rates. They imploded. Start of the year, T-bond rate was at 1.5%. By the time you go through and you look at where we are 3 months later, T-bond rates are at 0.76%. T-bill rate started the year at 1%, dropped to 0%. Why? Because real things were happening, right? The entire global economy had shut down. You weren't sure whether we were coming back. Risk-free rates collapsed in 3 months. In contrast, think about 2022. What happened to rates? They rose in the other direction, right? You started the year at 1.5%. You ended the year at 3.88%. See, so what? You value a company on January 1st of 2022. You come up with a value. You value the same company, nothing changes about the company. Same cash flow, same growth rate. Will you get a different value 9 months later? Absolutely. This notion that intrinsic value is some magical number that stays fixed over time is absurd because the world is shifting around you. So if you do your valuation on February 15th because you want to get the project done quickly, you're on top of it, you finish the valuation, could that valuation change by May? Absolutely. You're saying, does this mean I have to revalue the company every? No, you can. My suggestion is if you have an input page, keep it separate. Things like the T-bond rate, Definitely keep it as an input that just gets copied from the input page. Maybe even connect your input page directly to Yahoo Finance. You can do that where the T-bond rate gets updated automatically. Those numbers will shift on you because that's the way the world works. Your cost of capital can change, your cost of equity can change, and complaining about it that it's changing can't change reality. So risk-free rates can change. Risk-free rates differ because of inflation. Let's complete the risk-free rate process by bringing in one final issue. I told you there were about 40 plus currencies in which you can get a government bond rate. So even the approach that I described, you need a government bond rate to get started. But there are like 150 currencies in the world. There are some currencies where there is no government bond rate. You're saying, what do I do then? You have a couple of choices. One is you can give up and value the company in another currency. For the longest time in Latin America, people valued everything in US dollars. Why? They didn't trust the real, they didn't trust the peso. So that's one choice. So you value a Russian company. My suggestion is don't try to value it in rubles, right? It's already tough enough. Why add this to them? The other is you can say, look, I want to estimate a risk-free rate in the local currency, and I'll give you a way in which you can do it. And here's what I'm going to do. I'm going to go back and think about why risk-free rates vary across currencies because of differences in inflation. About 7 years ago, I had to value an Egyptian bank. I didn't have to, but I wanted to. And I valued an Egyptian pounds because I wanted to deal with the local currency. There was no government bond rate in Egyptian pounds. So here's how I got the risk-free rate in Egyptian pounds. I started with the UST bond rate. That's a dollar risk-free rate. You're saying, but this is Egyptian pounds? You're right. If I can look at the inflation rate in the US and the inflation rate in Egypt, let's suppose inflation rate in Egypt is 15% and the inflation rate in the US is 2%, or 1.5%. If you're in a hurry, just take the difference of 13.5%, add it to your T-bond rate, you now have an Egyptian pound risk-free rate. In other words, take the differences in inflation, you can get a risk-free rate in any currency. There are some of the government bonds on that list I showed you where I don't trust the rate. You know what I mean by don't trust the rate? The T-bond rate, whether you like it or not, is a traded number. There are billions and billions of dollars buying and selling T-bonds. So basically, it's a number from a market. The Pakistani government bond rate, I'm not so sure. Because in many government bonds, there is no trading. It's actually it's a rigid market. Banks are forced to buy the bond so you see where I'm going? A government bond rate might sometimes give you a very misleading view of a risk-free rate if it's not traded. The Venezuelan government still insists that it has a 10-year bond with a 13% rate. I don't know who's buying this bond, but they claim this is the government bond rate. It's nonsensical because your inflation is in the thousands of percent. So when you don't trust a government bond rate, go this route because this will always work for you. Now, part of you is saying, but how the heck am I going to forecast inflation? In the US, it's very easy. If you want to forecast expected inflation, what can you do? It's a market-based rate, yeah. Take the market, the T-bond rate, take the TIPS rate. That difference is expected inflation. You don't need to have economists and macroeconomic analysis, the market-based number. That number is about 2.5% right now, long term. You're saying, how the heck am I going to get the rate in Egypt? You estimate it. You're saying, what if I'm wrong? It doesn't matter. Sounds like an absurd thing to say, right? Let's say the true inflation rate is 80%, but you estimate it at 15%. You've underestimated inflation. You've underestimated the discount rate. But then when you do your cash flows, if you use the same 15%, you've also underestimated the cash flows by exactly the same amount. This is incredibly good news because I'm saying, as long as you screw up consistently on inflation, it's going to average out. So the next time you find yourself spending days and weeks estimating inflation, just stop. Estimate a number. Use the same number in your cash flows and your discount rates, and you're going to be okay because it's going to cancel out. Final loose end. A year ago, if you were valuing a US company in US dollars, the T-bond rate was at 1.5%. Historically, that's a low number. And the older you are, the lower it'll look. You know what I mean by that? It's actually behavioral studies that show that what you think is normal is actually set between the ages of 30 and 35. So, you know, So when people would say the T-bond rate is too low, I'd ask, what's a normal T-bond rate? It's 6%. My reaction is, you've been in the markets too long, time to retire. Because you probably started markets in like the 1970s, the 80s, if you think. If you came into markets in the 1990s, a normal rate, what I'm saying is people use the word normal as if we all agree on what a normal is. But remember, it's a reflection of your experiences, what you grew through. But a lot of people at the start of 2023 looked at that rate and said, that's too low a rate. And the minute you say that's too low a rate, what's the normal way to fix that if something is too low? Replace it with something more normal. And as I said, that number can be 3, 4, and there's an entire group of appraisers who decided to go this route, not just last year, but over the last decade. They've been playing with normalized risk-free rates. In my view, you're playing with fire on a number you shouldn't be playing with. Let's play this out. Let's suppose you decide to replace the 1.5% risk-free rate with a normalized number. Let's say it's 4% or 5%. So let's play out the mechanics. You've replaced what's an actual rate with a normalized rate. What's going to happen to your discount rate? It's going to go up, right? Your discount rate goes up, your value is going to go down. Your value, and let's say it goes down enough that it's lower than the price. You know why we do discounted cash flow valuation? If something doesn't pass muster, we say we have an opportunity here to invest elsewhere. When I use a 1.5% T-bond rate, I'm saying, look, if you don't invest in stocks, you can invest elsewhere and make 1.5%. But if you've normalized the rate, my question is, where are you going to find this 5% risk-free rate that you magically pulled out of nowhere? This is not something you want to mess with. You want to normalize margins? Be my guest. You want to normalize growth? Of course you can do that. But don't normalize risk-free rates because you don't control that outcome. That's an actual opportunity cost. Today, that problem has gone away, right? T-bond rates are back closer to what people think of as normal, but this too shall pass. I mean, 2 years from now, the rate might be 7.5%. You're going to feel the urge to normalize in the other direction. Stop messing with the risk-free rate. You got enough on your plate in terms of estimation challenges. Let the risk-free rate go. And if you have negative risk-free rates, no, you can. And of course, whenever we talk about T-bond rates now, who's held responsible for rates being low? The Fed. The Fed, the only rate the Fed sets is the Fed funds rate. It doesn't set treasury rates, doesn't, no. I still remember about, 10 years ago, 15 years ago, maybe when my kids were still at home, I took them into the Fed. They actually do a tour of the Fed. Have you ever done it? It's actually, I wouldn't say fun, but it's not that bad, right? So you go into the Fed building, which is it's downtown. You go in and there's a tour guide who takes you around. The most exciting part of the whole tour is when you go down and you see the big stacks of currency. Don't get any strange ideas. It's well protected. Yeah. So I take my son and my daughter and my wife, we go into the Fed. I almost made myself persona non grata about 2 minutes into the tour. The tour guide comes up, nice lady, 23 years old, 23, very young, very enthusiastic about the Fed. So I almost asked the question, can you take me to the interest rate room? When you watch CNBC, you have this vision of Jerome Powell sitting in a room, moving things around, right? The T-bond rate looks too low. Let me move it up a little bit. Or the mortgage rates are getting too high. There's no lever out there. All the Fed controls is a Fed funds rate. The next question I was going to ask her is, can you take me to that window? I'd like to borrow the Fed funds rate. You can try it out, but you're not going to get to a window, and you're definitely not borrowing the Fed funds rate. It's a rate at which banks borrow overnight. Yet, of course, this has become mythology. The reason rates have been low for the last decade is because the Fed has kept them there. What do we say drives risk-free rates? Inflation. So in this graph, here's what I've done. I've actually graphed at the red portion of the column is the inflation every year. It goes up and down. And the other component that goes into a risk-free rate is a real interest rate, which can be captured by real growth over time. So I've taken the GDP growth each year. So if you add the inflation rate to the GDP growth rate, you get what I call an intrinsic risk-free rates. So when inflation is high and real growth is high, what's high plus high? Humor me. It's high. Rates will be high. And for the last decade, take a look at what happened. We had low inflation and anemic growth. Low plus low is low. I'm not telling you the Fed doesn't affect rates, but the reason rates were low for the last decade is because you had low inflation and low real growth. And the Fed at the margin could affect it, but if inflation had been 5% for the last decade, nothing, no QE1, QE2, QE3, whatever you did, could have altered that reality. So when you think about interest rates, don't fall into the trap of assuming the Fed is going to raise rates this year, lower. I mean, you hear this all the time, right? We're going to have higher rates this year. How do you know? The Fed's going to raise rates. What rates? You know, last year, the Fed chased the market all through the year. They raised rates after, in fact, you know, I'm reminded of the story of a rooster called Chanticleer. Have you ever heard the story? It's actually a fun story. It's about a rooster that rules a farmyard. And the reason it rules the farmyard is all of the other farm animals think that the rooster's crowing is what makes the sun come up. So they pay homage and say, oh, great rooster. And for a while, rooster rides high. Then one day, the rooster oversleeps. His iPhone didn't go off or whatever it was. He oversleeps, and guess what happened? The sun came up anyway. And the other animal said, you're not making the sun come up. You happen to crow at the time the sun comes up. I think the same way about the Fed. The Fed doesn't drive rates. It kind of, if it's sensible, actually makes it look like it's controlling rates. That's the only way you get power here. But rates do change over time, and they change over time not because the Fed is making them go up and down, but because the fundamentals are shifting. So will rates go up this year or go down that year? What's the real question I need to answer to be able to answer that question about rates? What will happen to inflation this year? And what will happen to the economy? That's a healthy discussion rather than watching the Federal Open Market Committee go through its meetings. And finally, there are some currencies where the risk-free rate is negative. I'm sorry, what's your name? Ashley is valuing Nintendo, Japanese company in Japanese yen. Japanese yen. It's a negative risk-free rate. It's had a negative risk-free rate now. It's actually nominally it's positive, but because it's defaults, Japan is not AAA rate anymore, you end up with a negative risk-free rate. Now, part of the reason people are uncomfortable using negative risk-free rates is to say, if I use a negative risk-free rate, won't my cost of capital be low? Absolutely. It's just the pure math works. But if you think about what a negative risk-free rate is telling you about the future, it's telling you that there's going to be deflation in the yen. And even though Nintendo is a global real growth phenomenon, when you talk about the big currencies, it's not the real growth in that country that gets reflected as much as global growth kind of showing up in the risk-free rate. So the long answer to the question of, can I get away using an? Absolutely, you get a low cost of capital. But once you get to growth, you're going to have to recognize that you're now operating again. It's almost like you're swimming against the tide. You have to grow at 6% to show a 5% growth rate. So you're going to have to be conservative in your growth rates because that's what the inflation effect is going to be. And once you get to the terminal value, you talk about growth rate forever. I'm going to impose a rule that I'll come back and revisit. You should try to cap your growth rate at the risk-free rate. And people will complain. They say, oh, negative growth. Well, you didn't complain when I gave you a negative risk-free rate and a low cost of capital, right? This goes back to the question of being internally consistent. So don't fight fights you don't have to fight when it comes to risk-free rate. No. Let the risk-free rate flow through into your discount rate. If it's low, it's low. If it's high, it's high. Just remember, your cash flows will now have to reflect whatever your risk-free rate is telling you about the future. So let's talk about equity risk premiums. I'll tell you what we're trying to measure, and then I'll take you different ways in which I can try to estimate it. And with each one, you can tell me whether it's going to work or not. You know what I'm trying to estimate the equity risk premium? It's what investors are demanding as a premium when they buy equities today over and above the risk-free rate. Risk-free rate, T-bond rate right now is about 3.5%. When people are buying the S&P 500 or they're buying US equities, they're obviously not settling for 3.5% as their expected return. They want to make more. How much more? That's what an equity risk premium captures. Already you can see that this number is going to reflect the risk aversion of investors. As people get more risk averse, the premiums are going to get larger. It's going to reflect how much risk they see in equities collectively. And that's going to shift over time. And any good measure of the equity risk premium then has to be dynamic. Do you see what I mean by dynamic? It's got to change in the world. So if I'm valuing a company in the middle of March of 2020, when COVID was shutting the global economy down and everybody was terrified, my equity risk premium should reflect that fear. So that's what a good equity risk premium has to be forward-looking and dynamic. I'll tell you how 90% of discounted cash flow valuations get an equity risk premium, and you can decide whether it meets our forward-looking and dynamic test. The way most people estimate equity risk premiums, most appraisers, most banks, is they look backwards. They look at the last 50 years, the last 80 years, last 100 years. They look at what would I have made investing in US stocks, what would I have made investing in US treasuries. They take that difference and they use that as their equity risk premium going forward. It's called a historical risk premium. Now, what are they drawing on when they do that? It's called mean reversion, that things revert back to the average. Powerful force? Absolutely. And if you have an economy that's stable, it'll tend to be mean reverting, right? Because things will deviate from the mean and come back. And the much of the 20th century, that was true for the US, the most mean reverting economy of all time, because it was the global economy. But we're in 2022. Do you think the economy is mean reverting to what mean? What's the average you're going to revert to? So the first problem with historical risk premiums is you're backward looking and assuming that the future will look not just like last year, but the last 100 years. You're on dangerous ground. It's backward looking, not forward looking. And is it dynamic? At the start of 2022, what's the average of the last 100 years going to look like? It's not going to change by the middle of the year. You got this 99-year number kind of dragging it towards. It's backward looking and static. I'm not done. Let me dig a hole and bury historical risk premium. Backward looking, it's static. And statistically, it's got a huge problem. In statistics classes, when I ask you to estimate an average of 100 numbers, you can estimate the average, right? Add the 100, divide by 100. Then what are you trained to put in brackets below the average? A standard error, right? You're saying, I've estimated the average, but by the way, I could be wrong, and here's the range on how wrong I could be. So let's go back, and this is on my website. I actually maintain these historical premiums, even though I don't use them. So let's go back all the way to 1928. That's a long time, right? 94 years of history. The historical risk premium for stocks or bonds, let's say it's 5.06%, second decimal point. I must know a lot about risk premiums, right? But take a look at this number, 2.15%. That is the standard error in my estimate. So think about it. I'm telling you the risk premium is about 5% and say, oh, by the way, the standard error is about 2%. Do you remember enough statistics to give me a range? How does it work? With 67% confidence, which means you can be wrong about a third of the time, right? If you want 90% confidence, you got to go 2 standard errors, which means the true risk premium can be anywhere from 1 to 9%. Fat lot of good this does you, right? And that's with 94 years of history. If I go back only 50 years, the standard error gets large. If I go back 10 years, it's almost all noise. Historical risk premiums are backward-looking, static, and incredibly noisy. But still we see entire valuations built around them. So when you look at historical risk premiums, factor in the noise, recognize that this is not a fact. So when people say, I got the historical risk premiums, 5.31%, ask them a question, what's the standard error? And say, what's the standard error? They've already lost the script, right? They think a historical number is a fact. It's not. And there's another problem. The only market in the world on which you got historical data going back 150, 200 years is the US. Many of the European markets had shutdowns during the Second World War. So there was, for continuous returns, you got to go to the US market. And there's a bit of a survivorship bias you get by looking at the US market as the basis for risk premiums. It was one of the most successful equity markets of the 20th century. We know that in hindsight. But you wouldn't have known that in 1901, right? So 1901, if you took your money and invested it, you'd have invested a third in the Austrian market. Guess what happened to that third? It was probably crashed and burned by 1945. So not only are we looking at a backward-looking static number that is noisy, but we're also taking it out of a market that was, in hindsight, do you see where this is going? If I build this in as my equity risk premium for the next 100 years, I'm assuming the markets I'm investing in are going to be the winners of the 21st century, and I have no idea. So we can play games with this number, but the reality is that the number, did I skip a page? Yeah, that the historical premium to me is not a great way to estimate it. And it gets even worse if I have to estimate this for an emerging market. Let's say you have to estimate an equity risk premium for Vietnam, and you decide that the way to go is to run a historical risk premium. How many years of historical data do you think you're going to have in Vietnam? 15 years at best. Brazil, you might have 30 years of reliable returns, and then before that, who knows what the market looks like. Even India, until the late 80s, the market was dominated by a few companies, very little trading. So if historical risk premiums are the way you estimate risk premiums for markets, you're very quickly going to hit a rock trying to estimate this number. So I'm going to give you the way I estimate risk premium. I'll use historical risk premium for the moment. I'm building off a shaky number, but I'll come back and replace that number. I'm going to start with the statement that I can't really do historical premiums for other markets. I have to estimate the risk premiums relative to the US. It's not because I'm being parochial, it's because that's a one market where I have enough data to actually start with the number. So let's assume you have a risk premium for the US. It could be historical. I'll give you an alternative that I think is better. But he says risk premium for the US is 5.94%. Looks like I pulled that number out of the air, but I'll come back and back that number up. That's my premium for the US. And let's say that I have to estimate an equity risk premium for Brazil. I don't know whether you remember when I did the risk-free rate in Brazilian real, I remember I came up with a measure of the default spread. You could use the government bond, 2.27%. You could use the CDS spread, 3.2%. You can use the rating-based number, 3.68%. And I said, don't worry, pick a number and be consistent. It's going to be okay. Sounded odd when I said that, right? Because you got very different risk-free rates depending on which number. But I said, once you pick a number, when you get to the equity risk premium space, I'm going to ask you to use the same number. Whatever makes your risk-free rate higher is going to also make your equity risk premiums lower or vice versa. The simplest way to think about an equity risk premium for a country, and this is the way investment banks estimate equity risk premium for other countries, is they take the US equity risk premium, God knows where that comes from, and they add the default spread for a country. So in Brazil, if you decide to go with the ratings-based spread of 3.68% and your US premium is 5.94%, 5.94% plus 3.68% gives you a risk premium of 9.62%. Now, do you see why I cleaned up your risk-free rate for the default spread? Because if I don't, you're going to end up double counting, right? Your risk-free rate, or so-called risk-free rate, is going to include that 3.68%. And now you're also going to push up the risk premium by exactly the same number. So this is the state of the art, if you can call it that, of getting risk premiums for other countries. And it's been around for 30 years. And when I first encountered it, I had a little bit of an issue with it. I said, I know default spreads measure risk, but they measure risk on a bond. This is equity, right? I said, why are we taking this risk that the spread we're charging for a government bond and adding it to an equity risk premium? So I'll give you two ways around that problem. The first is what some investment banks decided was a solution to this default spread problem. They said, let's focus on just equities. We don't even want to bring the bond in. We know the equity risk premium for the US is 5.94%, and we can estimate a standard deviation for US equities, the S&P 500. So let's assume that number is 18% for the S&P 500 and 5.94% is your US equity risk premium. Then they said, let's go estimate the standard deviation, the Bovespa, which is the Brazilian equity index. Say that standard deviation is 30%. Remember algebra problems from high school? You have an 18% standard deviation, market is charging a 5.94% default spread. If Brazilian markets have a standard deviation of 30%, that will make them about 1.67 times more risky, 30 divided by 18, than US markets. So you multiply the 5.94% by that 1.67, your equity risk premium becomes 9.90%. So here you're avoiding the default spread entirely. You're basing it on standard deviation of equity markets. This sounds like it's much more reasonable, right? I actually, in the paper that I would send you the link to, which is a really long, boring paper in equity risk premiums, I take every market, estimate the standard deviation for the market, and use this approach. You know that the equity risk premium based on this approach for Egypt is tiny. Because the standard deviation, the Egyptian market is like 5%. It sounds strange, right? Because you think Egypt, you think a lot of risk. When I estimate standard deviation, I'm estimating it based on the index level. But what causes index levels to move? In addition to changes in risk, somebody has to trade, right? If you have an illiquid market, let's take the extreme scenario. Let's say you have a market where there's no trading at all. What's the index level going to be every day? It'll be exactly the same number. Illiquid markets are going to have low standard deviations. With this approach, I'm going to underestimate the cost of equity and the equity risk premiums for illiquid markets. So the first approach, it's too rigid. I'm just using a default spread. The second approach works in some countries where there's a relatively liquid equity market, but will fail in a lot of countries which are illiquid. So here's the third approach. I call this my melded approach. I'm not going to claim it's magical. In the third approach, I bring together both approaches. I start with the US equity risk premium, just like the first two. I look up two standard deviations like the second approach, but there's two standard deviations I look up. Are the standard deviation, sorry. Are the standard deviation in the Bovespa, just like it in the second approach, but instead of looking at the standard deviation, standard deviation of the S&P 500, like the second approach. No, let me back up. The standard deviation of the Bovespa, like the second approach, but instead of looking at the standard deviation of the S&P 500, I look at the standard deviation of the government bond, the Brazilian government bond. Remember the 3.94% default spread went with the government bond? If Brazilian equities are 1.5 times more volatile than Brazilian government bonds, I'm going to take the 3.94% spread I had for the bond and scale it up to reflect the higher risk of equities. So let's summarize. First approach, you just take the default spread, add it on to the US equity risk premium, you're done. Second approach, you take the US equity risk premium, look up the standard deviations of the US equity index and the local index, and you use that scale number. The third approach, you start with the US equity risk premium, you take the default spread of the country, and then you bring in the standard deviations of equity and debt in that country. The advantage of that is one market is illiquid, the other one's going to be illiquid as well. So if there's hardly any trading in equities, there's going to be hardly any trading in the government bond as well. You don't get the mismatches, you get the second approach. Will the three approaches give you different numbers? Absolutely. How different depends on the point in time you do this. So let's think about expanding it, doing this for every country. At the start of every year, I do this for every country that has a rating. I'll talk about what I do with the countries without a rating. I start with an equity risk premium for the US, and I'll come in and fill in that detail. But the equity risk premium I got for the S&P 500 at the start of 2023 was 5.94%. So that's my equity risk premium for the US. For every country, I look up the sovereign rating for the country. Why? Because I don't have the resources to assess country risk in every country. I cheat and let Moody's do it for me. So what can I see? I'll see the rating, and it can range anywhere from AAA for Germany, Singapore, Netherlands, Australia, all the way down to, Venezuela's what, single C. I take the rating and I estimate the default spread. Remember the lookup table I showed you last session? So I have an equity risk premium for the US. I now have a default spread for each country. I want to go with the third approach. The third approach, though, I need a standard deviation in the government bond. And as I said, that's available for only like 40 countries. And even the 40 countries, I'm not sure I'm getting a number that's reliable. So I cheat. And here's how I cheat. To get that scaling number on the spread, basically, how much should I multiply the spread by? I look up standard deviations in two indices. One is an index of emerging market equities. S&P maintains this. So you can see it on their website. And the other is an index of S&P emerging market public bonds, government bonds. I take the ratio of those standard deviations. Start of 2023, that number was 1.41. See, what does this all mean? Let's say you have a country with a 2% default spread. You multiply 2% by 1.41, you get 2.82%. You add that to the 5.94%. You get an equity risk premium of 8.77%. And I do this for every country. Take the rating, get the default spread, multiply by 1.41. Very mechanical, but by the time I'm done, I'm going to get an equity risk premium for every country that has a rating. There are 140 countries with ratings. This is what the world looked like to me at the start of 2023. So let me explain. Let's start with the easy ones. The US, the 5.94%. I'll come and back up where I get that. But I gave the US a 5.94% equity risk premium. You're saying, why is Canada? It's the same. Because if you have a AAA rating, you have zero default spread. So every AAA rated country in the world has the same equity risk premium as the US. And I think that makes sense. If you have mature markets, it doesn't make sense for you to tell me German markets equity risk premium is 4%, the US is 7%, because they're both mature. Money should flow out of the lower premium market to the higher premium market. So every AAA rated country in the world, you'd see 0% as the country's risk premium and 5.94% as the equity risk premium. But let's pick a part of the world. Let's take Asia, right? There's my breakdown of Asia. And you can see that across Asia, there's only one country with a AAA rating, Singapore. And Singapore gets the same risk premium as the US. But if you go across the region, you can see that there are some countries with nice solid ratings. China, for instance, rated highly. And you also have countries like Myanmar and, basically where Myanmar is not listed, Mongolia, you got Maldives, so basically you can see the risk premiums vary across countries, but they vary because they have different ratings. I'll have to tell you, this is the most downloaded data set on my website. It gets used in the strangest places. I have absolutely no control in how it gets used. I've given up. Now, I noticed when, there was a time when I was noticing a lot of I can check how many people are coming to my website and notice a lot of Lithuanians coming in. I have nothing against Lithuanians, but this is a small country. So how's 11% of my traffic from Lithuania? And it turned out that the Lithuanian government had required people bidding for projects to use my country risk premiums to come up with discount rates. I remember getting an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand until I got this email saying, we're using your country risk premiums to set milk prices for New Zealand farmers. I said, what? Who are you selling the milk to, Zimbabwe? But usually the questions are, how do you come up with these numbers? And it's pretty mechanical. It's basically what I described to you. I start with the US premium, I describe the process, I get the rating, I get the spread, and I multiply this multiplier. But once in a while, I get an email and I'm not sure how to respond to it. I'll give you one of my least favorite examples. I get an email from Lebanon, from somebody who's obviously very pissed off at me. It was a Lebanese business person whose business had been appraised for value for sale. And the appraiser had used the risk premium for Lebanon from my website to come up with a discount rate. You can see even Lebanon's, you use a 30.63% risk premium. It was lower then, but it's still a pretty high number. You're going to come up with a high discount rate. Doesn't matter what currency you do the valuation, you're going to get a low value. And he said, how come you gave Lebanon such a low equity risk premium? As if I'm sitting there saying, I don't like this country, I'll give it a high risk premium. Initially my response was not my problem, take it up with your appraiser, but the email was from Lebanon, and I decided discretion was the better part of valor. And I decided to blame somebody else. I said, it's not my fault. You see whose fault it is? Why are some countries' equity risk premiums high and others low here? What's the driving force behind the equity risk premiums? It's your rating. I said, it's not my fault, it's Moody's fault. You want to take issue with them, take it up with them. Here's their address. All I'm trying to say is there's no intellectual firepower behind these numbers. Essentially, I'm taking ratings, driving them through, and therein lies a weakness, right? I think I've systematically underestimated equity risk premiums for the Middle East. Why? You take Saudi Arabia. There's very little default risk in Saudi Arabia. Nobody lies awake and says, well, because they don't borrow money. They have enough oil cash to keep going. They don't have much in debt. By focusing just on default risk, I think I'm underestimating the risk in countries where there is potentially political risk or other risks which might affect my equities, but might not affect buying bonds from the country. And by focusing on ratings, it also means that I can't estimate equity risk premiums for countries that don't have ratings. And until about 2015, those countries were not on my list. I still remember it's 2016, I get an email from a Syrian business person. Must be the last guy running a business in Syria. He says, look, I'm assessing hurdle rates for my business. And your first reaction is, you're assessing hurdle rates? Get your head out of the sand, get out of the country now. No, and I'm looking on your website for an equity risk premium and I can't find it. Why? And I told him, look, you're not rated. You're not rated, I can't assess a default spread. And he wouldn't let go. He said, so what do you expect me to do? How do I come up with hurdle rates? And I said, you have a point. I'll try. So starting in 2016, for these countries, they're called frontier markets. And I'll list some of them. It's countries like North Korea, Syria. Of course, if you're a business, I have a lot of business in North Korea. I'm already a little wary about whether I should even be doing a discounted cash flow valuation in the first place. But if you insist, clearly you have a lot of risk. Here's how I've decided to fill in the gaps. So they're up there. And you can see the list. It includes countries without a rating. I was able to find a score called Political Risk Services. It's a service in Europe that attaches a numerical score. And it goes from low to high. Low are the countries which are riskiest. And don't ask me why they did it that way. And high are the safest. Switzerland was the safest country, I think. And the riskiest might have been, I don't know, Syria. I took those scores and then I look for other countries with similar scores. So if you take, for instance, Syria, I know their political risk score. I find 3 other countries which have similar scores, and 2 of them are rated. I took that rating, and so it's cheating. I'm basically taking other countries with similar risk scores that have a rating and a risk premium and attaching it to them. But the bottom line is, when I'm done, I don't care where in the world you operate, I can at least give you a judgment on this is what your equity risk premium should look like. So that's how I get risk premiums for countries. Let's talk about going from there to, yeah, go ahead.
So on the last page, I noticed Guyana has high PRS, very low
country, right?
Why is that?
High PRS is good. Remember, PRS scores go from low to high. See, this is the problem with country risk scores, is people can go from low to high, economists goes from high to low. So the highest scores are the safest countries. The lowest scores are the riskiest. So when you see low scores, you're going to see high risk premiums go with that score. When you see low scores, you're going to see high risk premiums go with it, right? So but you can get mismatches, right? A country risk score can be, especially if you take the Middle East, you can have a very low default risk, but a high country risk score if people are worried about political risk or something else unfolding. So now let's talk about going from countries to companies. You're not valuing countries, you're valuing companies. And the question is, how do we go from country risk premiums to companies? Let's start with the lazy answer. The lazy answer is, you tell me where you're incorporated, I'm going to give you the risk premium of wherever you trade. So if you're an Indian company, I give you the Indian risk premium. It makes your life easy, but I think it's incredibly sloppy. And I already gave you the basis for that. Your risk doesn't come from where you're incorporated and traded, it comes from where you do business. So I'm going to push you towards that. And I'm going to leave open the possibility that sometimes you might use revenue, sometimes you might use production. But my end game is to argue that your risk premium should reflect where you do business. Now, of course, the easiest way to measure where you do business is revenues. And for 80% of the companies I value, I do use revenue weights. There are a couple of reasons. I want you to think about what the reasons might be why revenues are often the weighting mechanism. So here, for instance, I've taken Embraer, Brazilian aerospace company, weighted based on revenues. I've taken Bev, another Brazilian emerging market, weighted by revenues. Why do you think I picked revenues? One is beggars can't be choosers. To do this, I need data, right? Revenues are the one metric you will see companies systematically break down by geography. So it's not because I wanted to, I had no choice. It didn't break down, no. Some companies do break down things like EBITDA or operating income, but I'll tell you why I often pick revenues over those. First, revenues can never be negative, and that's a good thing. You see why? If I use EBITDA or EBIT and one part of the world has losses, how do I come up with a weighting mechanism? Do I give a negative weight to Latin America because you're losing money? It doesn't quite work that way, right? So revenues are available, they're always positive. And that's where you should probably start. See if you can see the revenue breakdown. Now, one of the things you're going to run into, and I'll tell you up front, is you're going to be frustrated by how your company reports revenues. Because companies are incredibly, I won't say sloppy, but strange about the way they break down revenues. If you're doing a European company, most European companies break revenues down into Europe, maybe North America, and EMEA. You know what EMEA stands for? Basically, they include Africa and the Middle East. I mean, they put it all into one basket. They say, what the heck are you guys doing? What do I do with this basket? You will see, and US companies have another problem. If you look at the revenue breakdown, it'll be revenues in the US, revenues in the rest of the world. Come on, guys. The rest of the world is a really big place. Can you start to get more specific? I know accounting pushes for all these changes. I wish they pushed for changes on revenue breakdowns that actually helped us in valuation. But you got to live in the world you're in. So whatever your company breaks down, try to use it to come up with risk premiums, but you're assuming that your risk exposure is driven by where you get your revenues. The problem though is if you have a company like Coca-Cola, they can't break down by country. Why? They're in 75 countries. So they break down by region. If you go back 2 pages and you look at the picture that I had for the word, there you go. If you look at the picture for the world, at the bottom, I've given you a regional equity risk premium. You know how I come up with that regional equity risk premium? I take a weighted average of every country in the region. Why not a simple average? Because if you take Asia, I don't want to weight Vietnam and China equally. Obviously, if you tell me you're in Asia, you're far more likely to get your revenues from China than Vietnam. So what these are weighted averages, weights based on GDP. So I'll send you the spreadsheet with my country risk premiums. It's not rocket science. I pull up the GDP, I take a weighted average. And the reason I do those weighted averages is precisely because I have companies like Coca-Cola, which give me regional averages. I can use the regional equity risk premium to come up with an equity risk premium for the company. But still revenue based. But I told you the one exception where I don't use revenues. If you have a company that's a natural resource company, an oil company, a mining company, I think you have no choice but to look at where they get their natural resources, where they extract their oil. And oil companies are actually pretty good. They will tell you where they're is an example of this. You take Royal Dutch. So in 2015 or 16, I valued the company. They told you where they get their oil and gas, and I took a weighted average based on where they get their oil. So in pure consumer product companies like Coca-Cola, revenue weights work fine. In natural resource companies, production or where you get the oil weights. But there are some companies we might decide to include both. And you have to decide, hey, which matters more? And it's a judgment call you got to make. So when you look at your company, start with the revenue breakdown, then ask yourself, is this the kind of company where I have to look at where their production comes from? Companies are very opaque about that, but if you know that, then you might want to bring that into the picture as well. The objective is you want to make sure that your risk premium reflects your operating risk exposure for the company. So I want to make sure that everybody's okay with that intuitive rationale, that a risk for a company doesn't come from where it's incorporated and traded, but from where it does business. And then we can debate, how do we measure that exposure? Should we use revenue? Should we use operating income? Should we use EBITDA? I'm open to suggestions, but I think that is a healthy debate. It's a debate we should be having about how do we capture operating risk exposure. So yeah, go your question. Yeah. Go ahead. Yeah. You have to decide 60, 40, 50. Just the one rule is the weights have to add up to 100%. So if you decide to go half on revenues, half on production, you can do that, but you got to make that judgment call depending on how easy is it to move your manufacturing. With oil and gas, obviously it's impossible. So somewhere between the very easy to the impossible, you got to put your company on that scale, because that's what's going to determine the relative weights. Now, I've kind of conceded this as I've gone along. Now, you can use revenues, but there is a danger of using revenues, right? Which is your exposure might come from your factories being in a country, and if your country shuts down, you won't be able to use it. No. And the question also that you have to face is, what do I do with this equity risk premium for my company? Should I assume it's a constant? So if you tell me you're in countries, it's 3%, or should I scale it up if you're in a risky business? In other words, you get a double whammy if you're a risky business in a risky country. Do you see why? If you're selling a discretionary product in a very risky country, you could argue that you're exposed not just to country risk, but you're overexposed. So I'm going to show you 3 ways in which country risk premiums get played out. And you're going to see very different numbers come out, but they're not coming out from the equations. They're coming out from different assumptions we're making about how country risk plays out in your cost of equity. And finally, if you think about country risk in specific, there's some companies which have exposure to a single country, and you worry just about that country. You don't care about the rest of the world. You say, I want to focus in on this country, and I want to get a more refined measure of country risk, where I look past revenues, I look past earnings, I look at everything the company is doing. And I'll give you the roots of this approach. It was about 20 years ago, I was flying to Brazil to do a valuation seminar. And at that time, I was doing what other people did, which is treat all Brazilian companies as equally exposed to Brazilian country risk. And 2 companies in my that I was using as lab experiments. One was Embraer, the Brazilian aerospace company. And if you're not familiar with it, the next time you're on a short haul flight in the US, take a look at the aircraft, probably an Embraer aircraft that you're flying on. And the other was, company with a more localized. It was basically, I think it was Ambev at that time, almost entirely a Brazilian company. And I was using the same equity risk premium for both countries. And I said, you know what, for both companies. And I said, that doesn't make sense. Embraer gets 97% of its revenues outside Brazil. And even though its factories are in Brazil, it should be less exposed to Brazilian country risk than Embev, which gets almost all of its revenues in Brazil. So I decided to concoct a measure. Notice the word I use, concoct. Derive means deep thought went into it, but I'm on a plane, 30,000 feet up in the air, I'm exhausted. I concocted a measure that would measure a company's exposure to country risk. I decided to give the measure a name. I called it Lambda. Why? Because I've decided attaching a Greek alphabet to things gives it this layer of sophistication that makes it less likely that people will push back. I said, I'm going to come up with a Lambda. It's going to look a lot like a beta. So if you're as exposed as the typical company in the country, I'm going to give you a Lambda of 1. If you're more exposed, your Lambda will be higher than 1. And then if you're less exposed, your Lambda will be less than 1. Then I went to sleep, landed in Brazil, did the presentation, threw this idea out. Then one of the more pragmatic people in the audience says, well, how exactly are you going to measure Lambda? I said, I haven't thought about that yet, but I have a long flight back. And on that long flight back, I actually wrote a paper that's still on my website on estimating what are the things you would look at to estimate Lambda. So you start with things like where are your revenues, where's your production, what risk management products do you use? But also things like, are you a company that the government views as being in the national interest? If you are, your Lambda just went up, right? Because the minute you get tagged as a company in the national interest, there is going to be a government effect. You're going to be more exposed to that country. So essentially, I said, if I had all this information, I wanted to get a more refined estimate, how would I do it? And I came up with multiple ways of doing it. But one of the things that I said was, hey, you could start with revenues and come up with a Lambda. It's a very simplistic approach. And I'll give you the way it would play out. Let's suppose you took 2 Indian companies, Tata Motors and Tata Consulting Services. They're both part of the same family group. But Tata Motors in 2008-9 got about 91% of its revenues from India, and Tata Consulting Services got about 8% of its revenues in India. They're both Tata companies, they're both Indian companies. The typical Indian company got about 80% of its revenues in India, 2009. So here's a simplistic estimate of Lambda. For Tata Motors, I'm going to take the 91% and divide by 80%. I come up with a Lambda of 1.14. It's more exposed than the typical Indian company because at least in 2008-9, it was getting more of its revenues from India than a typical Indian company. You know that number changed next year, right? What did Tata Motors do in 2009? They changed their exposure to India. They bought Jaguar Land Rover. The minute they did that, their revenue portion in India dropped to 70%. The Lambda decreased, but that's what you'd expect, right? You bought a large global company, you've made yourself less exposed to Indian country risk. In contrast with TCS, you divide 8% by 80%, you get a Lambda of 0.09. You take that country risk premium for India, you multiply by 0.09 instead of 1.14, you can see that the cost of equity I get for a company with a low Lambda will be much lower than the cost of equity that I get for another company in the same market with a higher Lambda. I use this only as an exception. For most companies, I do what I showed you with Coca-Cola. I take a weighted average, I wash my hands off, I move on, I have bigger fish to fry. But if you gave me a company with a single country where, where exposure to that country, you want to get a much clearer sense of what that exposure is, then maybe a Lambda approach is worth exploring, but it's going to take more work, more data to get there because you're trying to make it richer. But you're still basing this on revenues, right? It's simplistic. Here's another way in which you can think about Lambdas. What does Lambda measure? It measures how much your company is affected by changes in country risk, right? If you have a low Lambda, I'm arguing you're less exposed to changes in country risk than if you have a high Lambda. Does anybody remember how we get a beta for a company? What do? We run a regression of what against what? We take returns on a stock and run it against returns on a market index. Beta measures how my company moves as the equity index moves, right? Let's suppose I took returns on your stock and ran a regression against returns on a country bond. Do you see what I'm capturing? Why do country bond returns switch? Because country risk goes up and down. Country bonds go reflect that, right? So if you have a company that's very exposed to country risk, you should expect its returns to be very sensitive to what's happening in the country bond. So I ran a regression, and this was a mess to do. That's why I do it very infrequently. I took, this is in the case of two Brazilian companies, one Embraer and the other Embratel, which is the phone company which got all its revenues in Brazil. I ran a regression against a bond called the C bond. The C bond was a Brazilian dollar denominated bond. So what causes C bond returns to shift is Brazil's country risk is going up and down. I ran a regression. And here's what I got as the output. For every 1% change in the C bond, Embraer's returns moved by only 0.27%. It was relatively less exposed. So its country risk went up and down. Why? Because it got 93% of its revenues outside Brazil. The fact that Brazil was getting riskier, safer, people didn't care as much. In contrast with Embratel, every 1% change in the C bond translates into a 2% change in returns. Let's make this now, take the Adani valuation. This is a company, for better or worse, that is so closely tied to Indian country risk. It's a very different company than valuing Reliance Petrochemicals, right? This is a company who your views on what will happen to the company are almost completely linked up to your views on how India will grow and the infrastructure investment. I'm not going to try to estimate a Lambda, but if you think about the Lambda for an Adani, you're clearly not just exposed to Indian country risk, you're exposed far more than the typical Indian company. I'm not saying it's a good thing or a bad thing. But that's what we're trying to estimate with Lambda is how exposed is my company to country risk, and is there a way to calculate it? So I've thrown a lot of different ways of thinking about this. Let me try to bring them all into one page, and I will leave you thinking about this page. Okay? 2004, let's suppose I want to estimate a cost of equity for Embraer. I'll give you 5 different ways I can estimate the cost of equity. And they're going to give me very different numbers. But two of the numbers are going to deviate from the other three. And I want you to think about what I'm assuming in the two different approaches, or the two sets of approaches that give me different numbers. In the first one, I use what bankers do. Treat Embraer as a Brazilian company, give it the country risk premium for Brazil. And at that time, the country risk premium for Brazil was 7.89%. Huge, because this was right after Lula was elected for the first time in Brazil. People were worried about what the future would bring. Risk premiums had shot up. So I got 17 point, and this is all in US dollar terms. So I'm not even doing it in real terms, 17.24%. If I take the second approach, I took the same 7.89%, but use the revenue weights to come up with my risk premiums. And because it gets only 3% of its revenues in Brazil, I get a much lower cost of equity. In fact, the three approaches give me 9 to 11% cost of equity, are all approaches where I look at where Embraer gets its revenues, whether it's a Lambda approach or the weighted revenue approach. The two approaches where I get much higher numbers are approaches where I treat it as a Brazilian company. So the big decision I have to make here is, should I look at Embraer as a Brazilian company, or should I look at where its risk is coming from? Because that's going to make, and within that, if whether you multiply by beta or not multiply by beta, the effects are much smaller. Will my valuation be very different if I use a 9 to 11% cost of equity instead of a 17 or 18%? Absolutely. That's a consequential choice. And I think I've given you my biases, which is I think the 9 to 11% is a much more realistic cost of equity for Embraer than the 17 or 18% you get. And this is going to be true for a lot of emerging market companies, which have significant exposure outside the emerging market. But if the rest of the world treats them as Brazilian companies or Indian companies, they're going to be given this high cost of equity and a low value, right? So here's my final question. Let's assume that you believe that risk comes from where you do business, not from where you're incorporated. That's what you think should be priced in. Let's assume markets disagree with you. They're pricing things in based on where a company is located. I have a question about what kinds of companies are going to be undervalued by the market if it makes that mistake. Do you see where I'm going with this? In the case, if you take in, it's going to Infosys, the TCS is the world that are going to be undervalued. In the case of Brazil, it's going to be Embraer that's going to be undervalued. Let's say you go buy that undervalued company because you think market's doing the wrong thing. Why do we make investments? Because we want to make money, right? So what has to happen? Money. The market has to come to its senses, right? Think, when will that be? I don't know. But you know what will trigger it coming to its senses? Is a crisis where the rest of the is melt down, but Embraer is able to report earnings no matter what. It's the reality that stares you in the face, but you have no idea when that reality check will come. I think the way in which emerging market companies are valued and priced often reflects a very misplaced sense of risk coming from where you're in corporate and trade. The flip side of that, there's a lot of US companies that are really emerging market companies. Coca-Cola has 60% of its revenues from emerging markets. We need to be treating these companies as riskier than they are. So this is not just about emerging market companies. It's a point I'm making about multinationals in general. So let's stop with that. When we come back on Wednesday, we will continue with this discussion.